Hello, I'm Andrew Comstock, and I'm a principal here at Beyond Wealth. And today we're going to cover the topic of employee stock purchase plans, or ESPPs. So these things go by a lot of different names. Some companies brand them specific to their own company. You've heard the term associate stock purchase plans. They're all essentially the same beast. And so we're going to jump into the details about why this is a good tool and what you need to know for your financial plan before you sign up for these. And then also to figure out, once you get the shares, what you can do with them. So let's just kind of kick off with how an employee stock purchase plan works. So right off the bat, more or less the first decision you have to make is how much you want withheld from your paycheck. So every single pay period, whenever you elect to participate in this plan, you are going to have a specific dollar amount or percent of your paycheck held out of it, and that's going to go into a trust account. And so that period, whenever you start that, is your offering date. And these terms are going to come into importance here in a couple of minutes. And then so you're going to have a period of time from when money accumulates in that trust account for you before you actually purchase your shares. And that period is going to be called the purchase period. And then the last thing you need to know is once you've acquired it, and that purchase period generally lasts about 3 to 6 months. So we're just going to use the 3-month example today because that's the most common that we've seen in our planning history. So during that 3-month, you're going to accumulate. And then at the end of that 3-month period, your company's going to actually go out and buy shares for you. Now, the cool thing here is that the purchase date, that's the date that the end period of the purchase period, a lot of names here that we got to keep straight. The important thing on that purchase date is you generally are going to be buying those shares at a discount. That's kind of the cool feature of the employee stock purchase plan. So let's talk about that discount. So I've had 5% withheld from my paycheck. It's at the end of the quarter, and I've got a share of stock that's selling for $100. The common amount that you generally see is a 15% discount. It can be as little as 1%. We've seen it at 5, we've seen it at 10, but 15 is generally the most common. So I'm able to buy shares at $85 per share at that dollar amount, which is cool. I get a 15% discount right away and start to help build my net worth a little bit. That's a really cool feature to have. Now, there's some company plans allow you to do a little bit cooler feature on the purchase price, and they offer you an additional, I'll call it a discount, but it's more so just a better timing. So what they'll do is they'll find essentially a low price during that purchase period. So for instance, if the price was $100 at the end of the purchase period, and it was $80 at the beginning of the purchase period, they'll actually let you buy it at $80 and then apply the discount as well. So that's what we like to call stacking the discounts and gets you an even more favorable purchase price. So once you've got these shares, what do? So we see a lot of people accumulate their shares over time. And so just because they don't know what they're going to do with them, they just tend to hold on to them for a while. That can be great. That actually is a fantastic way to compound, is if you have money pulled out of your paycheck every single pay period, you invest it 4 times a year in a chunk, and you don't do anything with that, as long as the stock is appreciating, it can lead to some pretty good outcomes. So the first thing we always say with an employee stock purchase plan is have a plan. It's in the title there, but it's got to be part of your financial plan. You've got to know where it fits in, and we'll get into that in future strategies about employee stock purchase plans. The other thing you need to understand is concentration risk. Is if all of a sudden this compounds over time, not only do you get your paycheck from your employer, but now you might have a substantial portion of your net worth, particularly now that we start seeing restricted stock units become a far more common way for bonuses to be issued, particularly in higher income folks. So you can have shares in your employee stock purchase plan. You may have some stock options. You may have restricted stock units. And you get your family's benefits from this place as well. So we've got to understand that risk. It's not something to be scared about, but you just got to understand the risk you're taking. And for some clients, it may not be a big deal. For other people, it may be something that we need to pay attention a little bit more importantly. So now once you've got these shares, what do you do with them? So there's the important things that we talked about: the enrollment period, the offering date, the purchase period, and the purchase date. All this data kind of comes into importance now. So more or less is if you can have a qualifying disposition or a disqualifying disposition with your ESPP share. So what does that actually mean? More or less, it means if you're holding your shares for the long term or the short term, they're going to get treated a little bit differently when it comes time to pay taxes on that. So let's talk through that. The first one is a qualifying disposition. So anything that you hold for at least 1 year past the purchase date. So you buy a share on March 31st, that's the end of that purchase period, and you sell it March 31st or April 1st the following year, you're good. That's a qualifying disposition. You get favorable tax treatment then. We'll walk through an example here in a second. The other criteria there is if it's after the 2 years after the original offering date, which is essentially when the period begins. And we see that far less often. It's more so the original purchase date. So let's say you only hold the shares for 6 months after you buy them and you sell them because you need to for some reason, or the stock has a great run, then that's going to get a less favorable tax treatment. So we're going to take a look at an example of both those scenarios and show you how the taxes are just slightly different. We're going to look at the difference in terms of the profits or the after-tax profits you get from a disqualifying disposition, and that's holding it less than a year essentially, and then a qualifying disposition. So let's just walk through here. So we're going to focus, the math is the same on a flat and a down market, and you can refer to our blog post on the beyond-wealth.com website to actually see some more information about this. But let's just say the example that we used, you have a purchase price of $100, you have a discount of 15%, you have a final price, your final purchase price is $85, you have a sale price of $115, and that happened less than a year after you purchased it. So you're going to be taxed everything at your ordinary income tax rate. We assumed a 32% tax bracket here. The reason this is because you've held things less than a year. The discount price is always taxed at ordinary income, and any profit that you have on top of the difference between essentially the sale price and the final price is going to depend on your holding period. We have less than 1 year holding period, so therefore we're paying everything at the ordinary income tax rate. And you can see our after-tax gains is about $20.40. Let's look at the next example. So we have a same situation. We've just held this for more than a year. So that discount is still going to be looked at the ordinary income tax rate. So that's essentially the $15 discount that we had, that we're going to pay our taxes on that in the 32% tax bracket. But the capital gains are going to be taxed at $2.25 or 15%. And that's going to be the difference between the $100 and the 115 here. And the logic or the thought process behind that is we've held things longer than 1 year. So it's almost like we're buying these shares in the open market ourselves. And so we would pay long-term capital gains then on that, opposed to short-term capital gains, which are taxed at our current income tax rate. So that's the difference there. You can see that the outcome is slightly better when you hold for longer. But that's just one data point that you need to take into consideration here. I'm going to stop sharing my screen and just kind of wrapping this up. When it comes to the employee stock purchase plan, we encourage our clients to take a look at it, at least kick the tires on it. It can be a fantastic vehicle because, one, it automates the savings process for us, but you've got to have a strategy about what you're going to do with these shares. You just can't accumulate them with no plan in sight, because that can lead to some issues. The other thing you need to know is where you stand with your shares. Are they in that less than 1 year where you would have a disqualifying situation, or would you have a qualifying disposition? You've got to understand that fact as well, because it can impact your taxes, particularly if you sell a big chunk to buy a house or to buy a new car or to pay for college. You want to know where you are and how that might impact your taxes. It's all part of the planning scenario. So we'll record another video shortly on strategies to consider here and how this actually might fit into your financial plan.